So today is going to be day two of the lab where we're going to be talking about technical analysis from zero. I have a short presentation that I'll be covering, and then I'll probably switch over to TradingView and talk about some charts depending on how we finish up. But let's go ahead and get started then. So today's class is going to be a class that I think most people already know, right? Like I'm sure all of you guys already know what candlesticks are, how to read them, what they mean, and all that good stuff. But I still wanted to include this at the start, just in case there were some people that were kind of confused about a thing or two, and to just clarify some things, and to also talk about price action on a slightly more advanced level and how to actually use it to the best of your abilities rather than just reading it at face value. So, this is how to read a candlestick, a simple bullish green candlestick, and a simple red candlestick, right? You have on the green candlestick, you have price opens, right, on this line over here, and then you also have the close, and then the upper wick is the high that it reached during that time frame, and then the lower wick is the low that it reached during that time frame. And then on a decreasing or a bearish candlestick, it's the same thing, but except the open is above the close. Now, these are for the simple green and red filled candlesticks. I personally use hollow candlesticks, which basically means that there's a slight difference between them. The difference is that when a candle is green hollow, right, it means that that price closed above previous day's close and above today's open, right? That's a hollow green candlestick. A filled green candlestick means that price closed above the previous day, right? So technically it's still green. However, it closed below where open on the day, right? So for example, if we gap up 1%, right, and then we end the day up only 0.5%, that candlestick would be filled green. And then in regards to the red candlesticks, it's the same thing. A red filled means price closed below the open of the day and closed below the previous day's close. If it's a hollow red, it means that price closed below the previous day's close but above today's open, right? You don't need to use hollow candlesticks. You could use the filled ones, but I just personally like using the hollow ones more, especially because I use the darker background just for my eyes, so it actually looks just a bit cleaner. But at the end of the day, it's just preference, right? Okay. So here you have some bullish candlesticks and some bearish candlesticks. Actually, you can disregard those, the terms at least. You have this candlestick, which is usually more bullish, right? Open with no lower wick and a close all the way up at the highs. This bar usually leads to continuation. And then you have the second, which is one with which is called a hammer, which is essentially, it looks like a sledgehammer, right? You have a long wick off the low, right, with a close back up near the highs. Then you have a normal bullish candle, which is just a candle that closes above the open with some distance with smaller wicks. Then you have the neutral candles, right, which is just an upper wick and a lower wick without much difference in without that much of a difference between the opening price and the closing price. And then you have the least bullish, which is also kind of bearish, which is a candle with a very large upper wick and a close back near the open. Next up, we got the bearish candlesticks, which is just the same thing but vice versa. You have the most bearish, right, which is just a candle that opens and closes at the low without much action from wicks. And then you have the second most bearish, which is a shooting star with a large upper wick, and it closed back to low of day. Then you got the normal bearish, you got neutral, and then you got the least bearish, which is one that looks like the hammer. Now, of course, your trading decisions should never come just simply off of one candlestick, right? No matter if we're talking about the weekly, the daily, the lower time frames, whatever time frame you're talking about, right? You can't let your trading decision come simply off of one bar, right? That should be something that is known and something that is universal across all types of strategies, right? Whether you're kind of being more of a shorter time frame trader or whether you're looking to swing stocks in a larger time frame. You always want to use context to reading a candle, and you also want to use multiple candlesticks at once, right? But by the way, guys, bars and candlesticks are the same thing. I just might interchange them whenever I'm talking. Next up, we've got support and resistance. Support is very simply a level where you see buyers step in, right? It's usually a specific price level that price likes to hold, and buyers like to step in and buy things off of that. And then you've got resistance, which is the a level where selling pressure comes, right? A specific price level that price is having trouble breaking over. And then you've also got a support and resistance flip, which is something that is very, very important. And very simply, right, a support resistance flip or a resistance to support flip is when a certain level is lost and is now acting as the opposite, right? So, for example, here you've got this resistance, price reclaims it. You want to see that buyers hold this resistance and flip it into support, right? Very simply. And for those of you that are wondering why that happens, think of it this way: there's a lot of people that go short at resistance levels, right? So when someone is short at resistance level and price breaks above resistance, they are now underwater, right? They are now red on their position and they're at a loss. They are hoping and praying that their position goes back to break even so that they could cut it. Where's break even? At their entry level, right, which is the resistance. So as price pulls back down, those sellers from back here are likely going to be buyers because they want to now buy back their position, which they were short. So they buy it back to stop out at break even, right? And it's the same thing vice versa. If someone goes long at support, right, and support breaks, and then price moves back into that support after being underwater, they will likely sell out of their position because it is now at break even, right? So they get to exit their position without a loss. Now, obviously, those are not the only reasons, but that's just one way to think about it and understand why support resistance flips do happen. But support resistance flips are definitely very, very important because they show signs of progress, right? Whenever reading a chart, you always want to see that buyers are progressing, right? Buyers are, let's just say if you're looking to go long, you always want to make sure that buyers are actually making progress, right? When they break and reclaim a specific level that is above them, you want to make sure that that level now holds, right? That way you're avoiding a failed breakout, right? By that level holding and by also understanding that now there is confirmation, right? Buyers are definitely present and they are playing slightly, I guess you can say, more aggressively, right? And then it's the same thing vice versa when we talk about short sellers. Next up, we've got demand and supply. Now, demand and supply zones are basically the same thing as support and resistance. The only difference is that a demand zone or a zone is not specific to one price level, right? It's more, excuse me, it's more so a range of demand, right, or a range of support. So instead of it being, let's just say, instead of support being just at the level 100, there's demand from 98 to 102, right? And the same thing goes with supply. It's a general area in the market where sellers are showing up. It is not specific to one price level, right? Um, this also goes into bear gaps and bull gaps and how to actually read those and understand how they work because they work very similar to zones, but I will be covering that into another topic in the future. Next up, we've got identifying uptrends and downtrends. So an uptrend is very simply when price is making progress and is moving higher, right? Price begins the day at 100, moves to 102, and then ends the day at 105, right? Price trended all the way higher into 105 by the end of the day. And within an uptrend, what you want to see is that buyers are stepping up and are accepting and are willing to buy higher prices, right? That shows that the stock is strong and that people are willing to buy this at a higher price, right? So stocks don't move in straight lines, right? I think we all know that by now. They move sometimes in a staircase manner, which is usually the most ideal kind of way that they move because that's usually the most tradable, right? Which is what an uptrend and a downtrend looks like, right? And then a downtrend is the same thing, but vice versa. Price opens, let's just say, at 100, moves down to 98, bounces to 99, and then from 99 it goes down to 97, and then from 97 up to 98, from 98 down to 96, right? It downtrends its way into the lows with every pop getting sold, and every time we move into low of day, that low gets broken. Obviously, not just intraday. We're talking on broader time frames as well, right? So an uptrend is just when price keeps making higher highs and higher lows, right? It shows that buyers are in control and they're willing to bid higher prices. A downtrend is when price keeps making lower lows, lower highs and lower lows, where sellers are selling every pop. Now, there's obviously different types of trends, ones that are stronger than the others, and we will also be covering how to identify those in the later days. Price could also be doing nothing, right? Which is something that most people fail to understand because, from what I've seen, traders are always trying to make something out of something, right? They're always trying to make something out of a chart and they're trying to understand what is going on. And a lot of times it could be nothing, right? You'd be surprised to know how often charts just sit around, right? Like for example, if you take a look at the market today, right, since October 10th, since that day that we sold off on QQQ and the Nasdaq specifically, right, price hasn't really gone anywhere, right? That's 3.5 months of action, right, where price really didn't go anywhere. Every time price was kind of seeing some selling pressure, you'd always hear people talk about we're in a downtrend, and then the second price starts to make some progress, everyone's talking about we're in an uptrend. Well, in reality, price was doing nothing, right? It was chopping up both sides, bears and bulls, buyers and sellers, right? And over 90 days or 100 days, price didn't end up doing anything and stayed within the same range. So always keep that in mind, right? Stocks and markets don't always have to be in a trend, right? A lot of times they could just be building out a range, right? To potentially set up for the move that's gonna come, right, later in the future. Or they could also just be chopping around, right, and nothing is happening, which happens pretty often, right? There's a lot of days in the market where the market is just flat. Like today, although intraday technically we did have a lot of movement, we ended the day basically flat on cues. All right, so always keep that in mind that stocks could also be doing nothing. Next up, we've got volume. Volume, very simply, is just how many units were traded or how many shares were traded. Whenever you have high volume, it means there's strong interest at that price level. Now, notice how I said interest and I did not say strength or weakness, right? Because it could be one or the other. If there's low volume, it means there's simply weak participation, and buyers nor sellers are interested at this price, right? Things are just kind of stalling. Next up, we've got some reversal patterns. Reversal patterns can be used to signal the current trend is losing strength and maybe reversing direction, either off the highs or off the lows. Sorry, guys, 1 second. All right, so reversal patterns signal that the current trend is simply losing strength and may potentially reverse direction. Now, if you guys know the way that I trade, you know that I don't like trading off of patterns, right? A lot of people think that stocks move the way they do because of patterns. That is not correct. That is incorrect, right? Instead, we want to use patterns to identify areas where the average retail participant could be getting interested in a chart, right? And we want to use patterns to also identify compression, right? So I'll be getting more into detail on this topic in the coming days, but just for educational purposes, so that you guys go through the same journey or the same kind of learning process that I went through, these are the basic reversal patterns, right? You've got the head and shoulders, which is when price makes an initial peak, pulls back, and then goes and makes a high that is above that initial peak, but then eventually pulls back down and pops into that peak but fails to push out higher. And what it looks like is a head, shoulder, head, and then that can usually signal some selling to come, right? And then you've got a double top, which is price failing at one level twice. And then you've got a triple top, which is price failing at one level 3 times. And then you've also got, ignore the word rising. I hate something called a rising wedge. It just doesn't really exist, but it's just more so a downtrend followed by some consolidation and then a break of that mini consolidation to the downside. Those are your downside reversal patterns. And then you've also got upside ones, which is this is the head and shoulders but inverse, right? We've got a low that is made and then a break below that low, right, to make a new low that eventually gets bought up, and then a higher low off of this low and a move back up, right? And then you've got a double bottom, which is price testing into the same level twice, and then you've also got a triple bottom, which is price testing into the same level 3 times. And then you also have, again, ignore the falling wedge, you also have this kind of look where people like to call it a wedge or a bull flag or a pennant, where price is in an uptrend, right? Or is moving higher and then starts to consolidate and starts to compress and then breaks out. Right, so these are the most basic reversal patterns, but like I said, we don't blindly trade off of these. This is not how trading works. Instead, we want to use these just to simply identify where the average retail participant is potentially participating or looking to participate, as well as looking for these to represent price getting compressed. Next up, we've got the continuation chart patterns, which is essentially the same thing that I just mentioned, right? These all represent the same thing, right? A flag, a pennant, and a wedge essentially all mean the same thing, right? Continuation patterns are patterns that show prices pausing before continuing in the direction of the current trend, right? So you see price make a big move up and you're not long yet, right? You want to get long. What the average trader will do is wait for price to set up one of these patterns, which is essentially just price pulling back in, right? And getting tighter before eventually breaking out higher. A bullish flag is just when the price is kind of making um, a mini downtrend within the uptrend, if that makes sense, um, without getting too compressed. And then you have a pennant, which is price is not making higher highs or lower lows, and it's just kind of getting super tight before breaking out. And you have the wedge, which is both of them kind of together. And then you have the same thing vice versa, which is the bearish flag, the bearish pennant, and the bearish rising wedge, right? But again, like I said, these should never be used blindly, right? Stocks do not move because of patterns. That's just not the way it works. Stocks move because there's more buyers than sellers, or there's more sellers than buyers, or there's more people that are interested in prices at this level or a level higher, right? And so much more, right? Trading is not as easy as buying a bull flag time and time again, right? If trading was that easy as identifying something this simple, then everyone would be successful at it very easily, right? But it is not. These can be used, right? But you need to understand the context of the chart. And there's a lot of patterns where I will personally buy them, right? And then there's also a lot of patterns where I would not look to buy them, right? You guys have any questions about anything that I've shown so far? All right, if not, let me go ahead and switch over to my trading view screen. All right, so without getting too deep into the difference in patterns and when to buy them versus when not to buy them, I'm gonna simply be showing you guys two charts that the average retail trader would think are the same, but in reality they are not at all and they are completely different. The first chart that I'm gonna be covering is MU, and obviously not from up here, but instead from back here. Now, MU is a name that has not had a big run just yet as of this action from back here, right? And if you go into the weekly time frame, you could see that price is setting up what looks to be a flag, right? A bullish flag. Initially here, and then here again, right? Now, this is a very, very textbook long, right? When talking about patterns, right? This just looks super clean. Okay, pullback, you have a big move of 100%, and then you have a 20% pullback, right? And then you have a 24% pop, and then you have a 10% pullback, right? These are very, very simple flags. Now, when you start to break down the chart a bit more, you'll notice that, and also understanding the context of where the market was from back here. Again, I'm trying to explain it without getting too deep into the topics. But essentially what we did was we pulled back into a previous resistance spot that was held, right? Or a previous supply zone, right? You can see that every time we tested into this kind of 110 spot, price was getting rejected. And then we were finally able to flip it as support, and price began to hold on to that spot, right? You can also notice that we pulled into the weekly moving averages, right? And that volume was kind of declining here, but not really telling us much. If you go into the daily time frame, this also looks very similar, right? A large flag, right, followed by another kind of mini flag, right? Simple stuff, makes sense, right? If you go ahead and play this action, what you'll notice is that price went on an absolute insane ripper all the way up into 350, right? This is a generational long that you do not see setting up quite often. I did have it on watch from back here, and I did trade it a few times. But this is what a textbook flag looks like, right? Now compare this chart to something that looks like PLTR from back here. To the average retail participant, this also looks like a flag, right? When simply thinking about flags and continuation patterns, they both look similar, right? Can we agree on that? I think we can, right? But the difference is a lot, right? Now, on face value, they both look very similar, and they both look like continuation patterns that you're looking to buy and long, right? But the reality is that this is a name, right, that has already had quite a massive run over the span of 1 year, right? Starting from all the way back here when it was at 22, and now it's at 188, right? You also start to understand the chart and what this base actually looks like, right? Which is a distribution, but we will cover that later on. And you start to notice that this could be, instead of a continuation trade, this could actually be a late bull flag trap, right? Which is also what NVIDIA has set up right now, right? But I don't want to get into that just yet. If you go ahead and play the action of what happened, we sold initially and then we kind of just popped up, but we had no follow through, and then we sold 16% from that high. Right, so those are two completely different charts, right? And they show why continuation patterns are not just simply, okay, I'm gonna close my eyes and just buy this because this looks like a continuation chart, right? Trading is a lot more complex than just simply continuation patterns. And anyone that tries to dumb it down to you to just a bull flag and a bear flag is likely trying to sell you something, because it is not how trading actually works. You need to understand a lot more than just patterns, right? Just like understanding volume and context and so much more than that. However, I will say that knowing what a continuation chart or a continuation pattern looks like is certainly important. And the reason for that is because these continuation patterns, what they do provide you is one insight that is very important. And that insight is compression, right? Compression is simply price getting super tight, right? And like I said, this is, we've all agreed that this is what a bull flag looks like, right? Actually, let me try using this. Price is in an uptrend, and then it begins to pull back and set up a flag or a pennant. What is actually happening here is that price is getting very compressed between two kind of trend lines, right? And the way that stocks work, right? And you guys know I'm mainly an options trader, right? I obviously do trade shares as well, but um, my main activity is on options, right? And I think most of you in here are as well, or at least that's why you joined. But everything that I do talk about works on both options and on shares, but it is more specific toward, more geared towards options and how to actually capitalize on options to get big wins, right? So with shares, you can obviously buy things and just let them work out, right? You don't need a specific time frame for them to work, and you also don't have theta working against you, right? Now, theta is just, very simply, ignore the fancy word, it's just time decay, right? As time passes, the option value loses money, right? Just keep it as simple as that. So when trading shares, you don't have that. However, when trading options, you do have that. So the premium value does decrease over time, right? We'll dive deeper into that later. But so when trading options, your timing has to be very important, right? And I've seen a lot of people try to trade good charts without good setups, right? And what I mean by that is, let's just say someone is looking to go short, or let's just say someone is looking to go long on a name that's in an uptrend, right? With options, what they'll do is they'll buy on day one of a pullback, right? Thinking they got a dip, and this is gonna rip the next day. What happens is they go long. It's like buying this dip here, let's just say, right? And they're targeting up until, just say, 230. What happens is price starts to just consolidate, right? And as price is consolidating, they start to doubt their trade, and they either end up taking a loss or their premium loses a ton of value. And the reason for that is not because they saw a chart, it's not because their analysis was bad, right? Let's just say the broader chart that they were looking at looked good, right? This looked like this will break out and this will have a move back up to the highs, right? But the thing is, they missed out on some of the most basic stuff in trading, which is just simply understanding continuation, right? And how compression works. You really do need to understand this when it comes to trading options, especially. But you can't just simply look at it as face value, right? You need to dive deeper and past simply looking at chart patterns, right? So always keep that in mind that you want to wait for compression to take place, whether you are looking to buy calls or puts, whether you're looking to go long or short, you want compression, right? The more that a stock is compressed, two things are happening. The more likely it is to move today, right? So more compression equals more ready, and more compression equals more room for expansion, right? So always keep that in mind. Compression leads to expansion, right? More compression, more expansion. Very simply, right? So you always want to wait for price to get really compressed. And another way to identify compression as well, other than just simply looking at patterns, is inside days. A lot of people don't notice, but inside days are technically also compression, right? Think about it. What's an inside day? An inside day is a day where the range of price action stayed inside the previous days, right? That technically is compression, right? Price didn't move anyway, so therefore it's getting compressed. So you always want to look out for that as well, and look out for more and more compression, right? So back to the trader that I was just explaining, one that has good analysis but doesn't simply understand how continuation patterns work and how compression works, he would have gotten chopped up, right? Now you have trader 2 who has good analysis, right? Understands how price actually works, understands price structure, right? And has a good read on a certain chart that thinks is going to break out, right? He doesn't just blindly buy day one of the pullback. Instead, he gives it time to actually pull back and set up a bigger kind of form of consolidation, right? Um, so instead of just buying on day one, he waits for price to continue to compress, waits for inside day or double inside day to set up, and then he looks to buy it then, right? Being patient and being selective is definitely very important. I've seen a lot of a lot of guys that have good analysis, right, that understand charts on a broader level perspective and have kind of this broader market view, right, which makes a lot of sense. But they miss out on the simple stuff of trading, which is just simply waiting for a compression, right? This also works the same vice versa if we're talking about shorts, right? You do not want to be the guy that is shorting the first pop here, right? You want to wait for this to continue to consolidate and to continue to compress, and then look to trade the breakdown. Now, obviously, this is not just talking about the daily time frame, it's talking about the lower time frames as well, right? You want to wait for more compression, but you obviously want to give the larger time frame more weight, which is the daily or the weekly, although you don't usually see that many clean charts on a weekly time frame, because the weekly charts are usually slightly more messy. But regardless, you always want to wait for this, right? Like I said, it's the simple stuff that can take you far away in trading. However, you don't want to be that guy that dumbs trading down, right? Because trading is not something that is easy, and it's not something that should be dumbed down. Instead, it should be something that you have a strong foundation, have a strong backbone, right? That is simple, easy to understand, right? But can be difficult to execute because of many reasons, right? So, you guys have any questions so far about patterns or anything I've just talked about? When does compression when does compression invalidates my guess is when it broke out of the channel. Um yeah, so when it, let's just say if it breaks below these lows, then yeah, this could be entering a downtrend rather than compressing. But if it breaks this downtrend, right, so it makes a new low and then pops back into that kind of wedge, then it's just compressing on a bigger picture or a larger time frame. ATEX. Um, it is compressing, right? If you look at it from kind of this perspective, it's actually not a bad chart. It's a bit too dead for my liking, and it is a small cap. You gotta watch out with those. But if we're talking about technical specifically, then yeah, this is some clean compression. But I will say the compression that I like usually moves slightly lower, right? What I mean by that is instead of compression that looks like this, I personally like trading compression that looks like this. Does that make sense? And the reason for that is because this one here on the right has more room and it gives you a better entry, right? Because prices pulled back more. This one, although has not pulled back as much and could potentially have a slightly higher chance of having a failed breakout. Perfect. So always remember, guys, patterns are not the cause, right? Patterns are the effect, right? Patterns are not the reason stocks move the way they do. Which compression? So the the second one that I drew, usually the way that I like to buy continuations is I like to bid the undercut, right? So usually there's going to be some sort of support level that most traders are buying, right? So most traders, what they'll do is, let's just say price is consolidating, right? And then it starts to pop here. Most traders are going to buy this right here and set their stop under this 2050 level. Instead, what I like to do is I want to be the guy that's buying the stop. So I'll look for a price to lose this level and then I'll see if buyers are willing to bid this and reclaim the level before continuing out higher, right? But I won't just blindly buy a pullback, of course. I need to see um, sellers losing control and buyers starting to pick up the pace. Yeah, of course. We're also going to be talking about execution a lot more in the later weeks. So don't worry, we'll have all that covered. All right. So always remember, guys, continuation patterns should be the final kind of piece of the puzzle, right? You need to focus on a lot more. Sorry, guys. This weather's just kicking my ass. You need to focus a lot more on the overall context of the chart and understanding price structure of what's actually going on and what's the story that's trying to be told, right? Or what's the picture that's being painted instead of just blindly buying patterns, right? You don't want to be that guy that is longing every bull flag and shorting every bear flag because you are not going to win over multiple trades, right? Instead, the flags and the continuations should be the final piece of the puzzle, which comes at the end, right? Right as you see that continuation pattern setting up on a chart that you already like, right? Notice how I said already like because you've already seen the overall structure of price. Then you look to trade it because now you know it's ready because the continuation pattern is there, price is compressed, and it is ready for expansion. Does that make sense? And if you're wondering, well, what does price structure actually mean? Or how to identify a chart that looks good, or how to identify context, we will be breaking that down as well. All right, you guys have any more questions? Yeah, for sure. We're still just at the start. This is all just kind of intro. Once we start to get into the more advanced topics, there's gonna be a lot of good stuff. All right, if not, I'll go ahead and pause the recording here.